And welcome to the VSA Capital Tech and Transitional Energy Podcast on Thursday, the 30th of July. I'm down in sunny Cornwall. Phil's up in what's probably sunny London, is it?
It is very sunny.
Actually, I mean, what I would say is that at the moment, the tech and transitional energy space are pretty grim globally. But of course, London, we tend to look at the FTSE 100, which is hitting new highs because we're full of financial services and mining stocks. And so we're pretty immune to it all. Tell my word, down here in Cornwall, you're immune to just about everything. It's a little bubble. Although mining, of course, is still a very hot topic. I've just been this morning down to see a drill rig drilling away on the Great Wheel Vore. I mean, this has nothing to do with tech and transitional energy, but it's interesting. The Great Wheel Vore was drilled 200 years ago and was a very high grade and successful tin mine. But it stopped 200 years ago because basically they didn't have ventilation, they didn't have proper drilling equipment, so we're just using a bucket and spades sort of thing. And yet now, of course, we have all this modern technology, and there's absolutely no reason why it can't become a world-class mine again. And yet, of course, at the moment, it's valued at very little in the stock market. So anyway, we will see. That's not tech and transition energy. So yeah, it's been pretty grim, particularly in the States. Stocks coming up pretty bad. In Asia, stocks coming up pretty bad. Is there any good news out there on the global picture, Phil?
Well, one has to bear in mind that just how fast the stocks have run. I mean, the main thing to look at is semiconductors, which have doubled. The SOX, the Philadelphia SOX Index, has doubled nearly since March end. So they have really, really run up. The SOX is down by 20% this week, but that index contains all the leading semiconductor companies. Nasdaq's down 7%, SP 500 flat, the FTSE 100 up, as we pointed. But Andrew, we've had quite a lot of reporting from the US big tech companies, and of course the big focus, it's all about AI. Very much still, that's been driving the SOX and the semiconductor market, and it's all about what the Mag 7 are saying about AI and capital expenditure and their results, really.
Yeah, I think this week we had something like 15% of the S&P reporting. It's a vast amount. Anyway, yeah, look, I mean, AI and data centers is going to fill the news channels for quite a few years to come. But again, without wanting to turn this into a mining podcast, the way to play AI and data centers is probably through mining or energy and not through tech. The real question to me actually is, as the markets fall back so heavily with tech in the States, I mean, there was all that money, I mean, literally trillions of dollars invested in tech. As it comes back, is that just investors losing their money, or some of them getting out and looking to reinvest it maybe elsewhere? Now, that would be really interesting. But I don't know the answer to that, in truth, so we'll have to just pass. Anyway, enough preamble, I think. Phil, you better get going on some of your results and see if we can find something really interesting for our listeners.
Yes, we will do that. Well, let me quickly on the big tech reporting. I think for me, one of the most interesting ones was Microsoft results. And Microsoft has an offering called Azure, which is its data center capacity, but it's also 200 different products within Azure to help companies that are developing new software and want to take the business, digitize their business. And that this includes AI functionality as well. And Microsoft just reported its quarterly results, and the Azure growth was up by 43% to passing $100 billion. And the order books for Azure were up from $627 billion to $678 billion. I mean, so they're actually showing Microsoft, real end AI demand for AI services. So that was quite a standout for me. They slightly reduced their capital expenditure guidance down to $175 billion. But what was also interesting and has been weighing on investors' minds is all this capital expenditure. And Meta actually saw its free cash flow fall to $780 million from $8.6 billion a year earlier quarter when it published its second quarter results. And we spoke last week about Alphabet seeing the same thing, this reduction in free cash flow because of the scale of capital expenditure. And certainly that's been playing on investors. There's something else that came out this week which was really interesting in terms of overall tech, semiconductors, and what's happening in China. Was a website called theinformation.com publication said, citing sources familiar with the matter, quote, that an unknown Chinese company began manufacturing immersion deep ultraviolet light lithography machines. What does that actually mean? DUV machines are produced by ASML. And these machines are used basically to print the circuits on semiconductor wafers. So really, really important. Now, ASML dominates, is potentially years ahead, but nonetheless, it shows the Chinese advancing. Also, this week we saw the IPO of Changjiang Memory Technologies (CXMT) on the Chinese stock market. That was up fourfold because it's a memory chip maker. Again, potentially future competition for Samsung and the like. So that impacted semiconductor shares. But very interesting, Andrew, because it does show that China, particularly in semiconductors, where the US still very much dominates, it has about half the global market, are trying to advance their homegrown technologies.
Well, again, last week we talked about Chinese EV cars and how everybody's driving them. It only makes sense that they want to have their own chips in their own cars, along with their own batteries and everything else that goes in the whole sort of digital supply chain.
Absolutely, yeah, definitely. So that was yes, that was certainly shook the markets a bit. But yeah, moving closer to home, Rolls-Royce, Andrew,
Hmm.
had their interim results. Ticker is RR, 120 billion market cap now. I mean, these shares have, my word, what a performance. I mean, they're up 21% year to date, but 47% in 12 months. So interims, Rolls-Royce Aero Engines and Services, Power Systems, Nuclear Systems, their interim first half, they saw operating profit rise by 46% to $2.5 billion sterling, and underlying operating margins of 22.5%. I mean, there's a few interesting things in this, apart from free cash flow of 2 billion. We'll talk about this free cash flow on their revenue growth of. But what was interesting, Andrew, I saw in this is on the aero engine side, they are looking to improve what are called long-term service agreements. You've got to remember, they sell the engines and they service the engines and make a lot of profit from servicing. And so they're introducing new blade technologies to the engines to do that, and they're increasing flying time as well. They also said that they're partnering with Airbus and Qantas on these new ultra long haul flights, which I've not been on one yet, but that's using their Trent technology. So this is including the planned Sydney to London route, which is on the Airbus. Yeah, it's going to be the world's longest commercial route. There we go. But that's Rolls-Royce engines. And on defence, they're involved in the £8.6 billion combined. This is a global combat air program that they're exposed to. Obviously, AUKUS on submarines. What was it? I was very interested in what they were saying about the power systems. So this is their backup power generators. The market, their market for them there is data centers, and they were saying that they're expecting 25% growth in the revenues from that business to 2030. I guess that's compound growth from that, and they've raised their guidance as well for profits and cash flow. I mean, yeah, superb performance.
It's a quality company, obviously Rolls-Royce. What's interesting is that it is defence. It's the war in Ukraine. It's the global war issues. Are we in World War III? Sometimes I think we are. Sometimes I think we're not. But it was being, if you look back 20 years, it was flat, 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 flat until basically the start of 2023. And since then, as you say, it's up tenfold. And that's really all to do with defence and the fact that people have woken up to the fact that we've got to spend more on defence. And it just shows, in many ways, it's a case of, getting the big theme right is where you make your money. Maybe more so than actually stock picking. Don't know. That's an interesting debate, isn't it?
Yeah. Absolutely. I mean, we'll get onto defence. BAE Systems, but also Rolls Royce was the civil aerospace business and engines business. The way that's turned around, and we said thematically previously with this one, it's just the data centres. They just expose these great structural growth areas, which is what you look for. I mean, BAE Systems, which is our biggest defence company, they had their interims. The BAE Systems is aircraft, surface vessels, submarines, land vehicles, weapons, howitzers, right across the piece. They saw interim sales up by 7.9% to just under £16 billion. and the all-important order backlog was up to 84 billion. That's always looked at very closely, and just in terms of that sales growth, dropped through to profitability. So the pre-tax profit was up by 7.6% to 1.3 billion. But again, looking at this, this business are being exposed to the right areas. So they've secured a contract from the UK government to provide Turkey with training and support for Typhoon aircraft, and manufacturing is underway for that. Also, and being quite a driver now, is their APKWS system. What that is, that means Advanced Precision Kill Weapon System. There you go, it is defence. But this is a low-cost kit of 70 missiles and laser guidance systems that fit on fighter aircraft and are used as a very low-cost counter-drone defence solution. So they've been testing that. They've also completed a design review for a just under £1 billion missile warning and tracking satellite program. So it's just tied into all the right areas now of growth, and they've won awards for their self-propelled howitzer sets. I know that they're expanding their howitzer barrel production, I think, in the UK, but also their shell production as well. So across all areas of defence, current defence where there's real demand that they're exposed to.
Yeah, what I love about these defence companies is they claim they have the best defence missiles or decoys or whatever in the world that can protect you 100%. But then you walk around to the other side and they go, yep, we have the best missiles and attack weapons that can get through any defense. I mean, they really do try and sell both sides of the equation, if we see what I mean. I love it. It's just so amusing. Anyway, well done then.
Oh dear, oh dear. Right. So moving away from defence and a bit more onto other tech. Sage SGE to get £9 billion market cap, and this is it's accounting software. Many businesses use Sage accounting software, and I think the company, Andrew, suffered a little bit in terms of that share price over nerves of AI and its potential impact on pure play software companies like this. I mean, their shares are down by 17% in 12 months, but on their trading update, their customers are very much spending with them. I mean, the revenue is up by 11% to £2.1 billion in the 9-month period ending June. Also, their third quarter, so it's a 9-month period, but they're saying that the third quarter revenue is up by 12% to just under £700 million. Cites strong AI-driven product adoption, so within their accounting software and their cloud business. I mean, remember Sage was like pure play license and royalties, but the cloud business now is 1.76 billion of that 1.86 billion. So they really have, successfully transitioned to cloud. So that was Sage. Then getting on to kind of a bit smaller ones, Lucico. Tickers LUCE, 352 million market cap. Shares are up by 63% year to date, but down more recently. They had a trading update for the 6 months ending June. Lucico produce, this is wiring accessories, light emitting diodes, cabling, so not just used in lighting and electrical infrastructure in buildings, but also for EV charging infrastructure. The revenue in the first half was up by 13% to 143 million. Particularly, they cited their momentum in their energy transition revenue, which includes the EV charging, and that was up by 120%. Operating profits up by 14% to 15.8 million. But what's quite interesting, what was interesting in here was that they're saying that expected changes to regulated mechanics of demand flexibility have begun to crystallize. I mean, what is that? The demand flexibility? Well, it's all about EV chargers interacting directly with the national grid, and how that is managed and the sort of money that they can make from that side of the business. They're also saying that smart metering framework agreements are expected to reduce recurring revenue for EV charger to a more sustainable level in the second half. So I think that probably caused a bit of weakness, but nonetheless, the board continues to expect adjusted profits to exceed £40 million in 2026. So that was Lucico.
I'll tell you something on EV chargers.
Yeah.
Driving down last Thursday night.
Hmm.
My son and his wife. We stopped at the Exeter service station.
Yeah.
Now, the Exeter service station has a huge car park. It's one of the biggest of all the service stations on the way down the M4, the M5. And the number of EV charging points was just extraordinary. You obviously have the Tesla own charging
Yeah.
points.
Yeah.
They probably had about 30 there, 30, maybe 40.
Wow.
But in total, there were probably well in excess of 100 charging points and different sorts. Some were obviously fast charging and some were not so fast charging. But more than half of the car park was now for EV charging. That actually tells you a lot because the Exeter Services Station is a well-known service station. A lot of people use it because it's sort of a natural break at the end of the M5.
Yeah. Yeah.
You
Yeah.
head down to Plymouth if you're going to Devon, or onto the A30 if you're going into Cornwall, and it just tells you where we're going. It was extraordinary.
Wow. I mean, the infrastructure to get that in, that scale of charging as well. You know, the power infrastructure to
Yeah,
do that.
should look into that. I don't know where the power is coming for it all. Whether they've
Yeah.
got a big store of batteries or something somewhere, but anyway, it was
It-
amazing. Anyway, moving on.
yeah, yeah, yeah. But as you say, it's the way we're going. Right, getting on different tech. The tagging technology for offenders. Big Technologies, BIG is the ticker, 296 million market cap. Shares are up to 7% in 12 months. There's a trading update to June first half. So this is all about it's electronics technology for tagging offenders, but also they've got alcohol monitoring with GPS as well. So people who are being strongly advised to reduce their alcohol intake for whatever reason. Anyway, nonetheless, they had recurring revenue increased by 5% to £53.2 million. And their profits up by 14% to 14.2 million. I mean, Christ, they're making healthy margins, but we'll get on to big technologies a bit more about what's been happening here. And they had free cash flow up 42% to £9.6 million on turnover of £26.9 million. Cash balances stand at £67.1 million following a £33.4 million settlement in payments, quote, for the Buddy litigation. Now, Buddy is the name of the underlying technology behind big technologies. And this relates to a settlement in January this year of claims brought by certain former shareholders of Buddy Limited at the time of acquisition by Big Technologies in 2018. So there is plenty in the press and company statements that you can read about that. You can read about the settlement. But what's quite interesting now is that clearly the business is moving beyond that. Charles Lewington, the acting CEO, said the group has delivered strong progress in the first half with accelerating revenue growth and returning to good growth in the second half. Now, it's not just tagging in the UK, but it's also overseas as well that they're growing their business. So, interesting time to look at the company.
All right, we will have a look.
Okay, Traxis.
Yeah.
104 million market cap now. The shares were at the high of £9 in 2024, £3.50 now. But interestingly, Traxis is software for the transport networks, particularly the rail networks. This is all about managing all sorts of managing workforce, managing trains. It's involved in that, but also traffic data as well, traffic management, and wider transport. They've just made an acquisition or proposed this is Mistral Data Limited, wholly owned subsidiary of First Group, and they're acquiring Mistral for £48 million on a cash-free, debt-free basis. And Mistral is cloud software data for train operating companies. Again, it's in their end market. But it's very much involved with managing revenue, but running day-to-day operations. So this is all about monitoring rolling stock, where it is, where the staff are required to run the trains. Also looking at operational data from the trains as they're running. Now this is they quote high margin rail software business with high quality earnings, 30% adjusted EBITDA margin. Generated this, and 85% of the revenue is recurring. So that looks like a good acquisition for Traxis, needed to boost the business.
Yeah.
Yeah.
I think we're all though wishing back to Traxis a
Yeah,
few years back, aren't we, when it was trading at a significantly higher price. It's been a little disappointing, but there you go.
yeah, yeah. No, well, let's see if this deal makes a difference. And there we are, Andrew. That was the ones that I spotted this week. I don't know if there's any others that you've seen.
No, being down in Cornwall, I haven't seen too much. It's quite nice just to get away from it all and clear the head and get out the noise of the city, shall we say. But no, very good. As usual, if anybody's got anything they want us to talk about, if anybody wants to sponsor us, just let us know. Send us a message. We'll be back next week.
We will.
This podcast has been produced and edited by VSA Capital. It is intended for information purposes and not as investment advice. The information is intended for recipients who understand the risks associated with equity investments in smaller companies. Please do your own research and do not rely on a single source when making an investment decision. VSA Capital may derive fees from this content and seeks to do business with the companies mentioned.